Hello and welcome. You're watching Closing Trades on ET now, and the closing trades have taken a complete U-turn. At one point of time, we were looking at 21,600, but there has been a sharp reversal, almost 300 points off the highest point of the trading session, and the Nifty below the mark of 21,300 firmly. Yes, we are 40 points off the lows, but it's a bigger gap that we can see from the top of the day, and that's the biggest talking point today. The mid-cap and the small-cap indices have actually hit a one-week low, so a sharp fall there as well. And it's Reliance Industries, ICICI Bank and SBI. These are the three counters that are putting the maximum pressure on the index right now. These three stocks are putting almost 40 to 50 points pressure on the Nifty. The PSU index as well as the small cap index, these are the two pockets which have seen the sharpest fall from the start of the trading session. So small cap index, for instance, is down almost 4% from day's high. It's FMCG, which is the only sole soldier today. So Varun Beverages, Tata Consumer, Radico Khaitan, these were some of the names that were holding up in the green. India VIX has also seen a very sharp spike. It's higher by 6%, very close to the 15 mark. Almost the 8-month high is what we are sitting at. And if you look at the biggest single session decline, Aisha, this is the biggest single session decline that we are looking at since October of this year.
Oh yeah, absolutely. Not just that, the mid-cap index, where the maximum chunk of the gains have been made, that also has registered its one-day biggest percentage decline since October 23rd, and similar has been the price action for the small cap index as well. RIL, SBI, L&T, they alone are contributing to about 50 points of the Nifty fall. And look at the kind of spike up that you're seeing in the India VIX as well. It spiked over 6%. It's now nearing those 15 count. So that's really the texture of the market right now. Indiabulls Housing down 7.5%, Indus Tower down 7%, IRCTC down nearly 6%, India Cements down nearly 5.5%. Kamal Enterprises as well, which has crashed about almost 6% as we speak right now. Good time then to bring on board our experts and try and analyze what really is going on in the market. We've got Naresh Mirani joining in the studios. Sunil Subramaniam as well is right here with us to talk about what the fundamental picture is looking like. And of course, we've got Soni Patnaik as well joining in to highlight the technicals of the trading day so far. Soni, hi, afternoon. If I could just come to you first, what explains this sudden U-turn by the market? I mean, we were at 21,500 plus when we started off the day, and now sub 21,300.
Good afternoon, and thank you so much for having me on the show. I think 21,600 was where we spotted the Nifty cash levels today. I think high was 21,590. Although it was on expected lines that, the Nifty after taking out the resistance of 21,300, 21,400, it was to test this level. What we can see is that, both the indices are sort of on a overbought zone, and there was some expectation, some correction expected. So I suppose that this is that correction that was on expected lines, and it's a healthy correction. Although if we look at the broader picture, market is still above 21,000. The uptrend is still intact. FI's positioning and longs are still above 60%. So there are a lot of positives also to look at. I just feel that this particular correction we've seen today should be a good opportunity to reinitiate your longs for those especially who've missed out the entire rally. So I think it's just on expected lines. It's a healthy correction, not a lot of panic to do. Pick quality stocks and stick to the uptrend, just ride the rally later on. And that's how we can see the markets coming out to be.
Okay, so not too worried calling it a healthy correction. Naresh, will you concur with the view? Because it's the ferocity of the move which is a bit startling.
So if we look at it, we had a clean run from 19,500 to 21,600. We did not have much of a shakeout. We only had gap ups and gap ups. So today is the day where we see a shake off, and this shake off indicates that now we can make a consolidation zone wherein we get into a range. So yes, the correction was needed to remove all the complacency we had. We could just get up every morning and buy, and it was working out. So today is the day where you take cognizance of the market that there can be volatility. So the last big gap up was at around 21,100 to 200. So that's a base for this market right now. So around closer to 21,200 is where you want to buy. On the upper end, like I said in the morning, 21,650, 700 could be the zone of resistance. So we get into this 500 pointer range for say a week or two, and then maybe we get into a fresh move. So overall, buy around 21,200, stop below 21,000. So that could be a fresh entry point over the next couple of sessions.
Right. Let me take it across to Sunil Subramaniam as well. Sunil, hi, afternoon. Good to have you in the show. Of course, this year has been historic for the equity markets, but at the fag end, would you say year-end compulsions perhaps at play? And yes, why not take some profits off Is that what's acting up in the market and playing out right now?
No, I think that it's been coming for some time because the hedge funds normally book profits in the last 2 weeks of December. This time, the first 2 weeks of December saw such a massive buying because of the December 3rd results, which gave a strong continuity factor to foreigners looking from a short-term perspective. Oil prices continue to trend low. So India was obviously a lot of fresh money came in, but typically the last 10, 15 days.
Sunil, we have you on a very scratchy line, so we'll try and repatch. But Naresh, just coming back to the point, when you were saying that consolidation is going to be the game going forward, what is the range to watch out for now? On the upside, what is that marker?
So on the upside, 21,650, 700, which is where there could be a pause. 21,100, 200 on the downside that you want to buy as closer to it. Because that is where the big gap up happened and we saw next 3-4 days of follow-on action. And what we are seeing is, it is across the board. So today the shake-off is not just large caps or mid caps, it is across the board. So this is an indication at least a short-term top is in place for the next maybe a week, 2, or could be a little more. But overall, the structure longer term is positive. We broke out at 20,200 odd levels, 20,500. Now we could get into a higher base. So till the time you don't break 21,000 on a sustaining basis, I would continue to ride on to the move and look for buying on dips.
Actually, I was just looking at the global markets as well as to something went wrong globally that warrants such a sharp reaction. Not really. The European markets are still holding in the green, and if you look at the pre-market from US, yes, they are down, but anywhere between 5 to 30 points, which is pretty much nothing for that level of index. So, no, it's not a global-led move that we are seeing. There's a bit of a correction in our market itself. But Sunil is back with us and hopefully on a better line. Sunil, just complete your point as to what you were saying about the market. Because yes, it was getting a bit toppish, but where do you take the money off the table now? Which sectors do you book profits?
So you're asking me?
Yes, Sunil, the question is for you.
Yeah. So now, let me finish my thought process, right? So I think that there are two different flow factors in the market, right? There are existing hedge funds which have taken a call on India quite some time ago, right? And they would have to book profits in order to receive their bonuses. It's a typical year-end phenomenon which happens. Second, you have fresh funds taking a view near term. So after December 3rd, the election results, 50,000 crores coming into the market. So
try and repatch that in just a second. Apologies for that audio. 130 points lower for the futures right now as we speak. But Naresh, let's just focus on what's happening within the small and mid caps, right? Because that's where the chunk of the gains have been made all through this year. Do you sense that while it could be consolidation for the Nifty, it may be a little bit of ease off or correction perhaps for the mid and small caps?
So if we have such a large move wherein we are up 30-40% in quick time, a correction of say 6 to 8, 10% from the top would be normal. This is the first day where we are seeing a 2.5%, 3% correction on the small cap indices from the top. So overall, yes, this could go a little more over the next couple of sessions. But we saw this happen 2-3 months back in September also. We saw a single day where the small caps were down 3-4%. The next day there was a little bit of follow-up and then we went up really hard. So the case is there would be one time when this does not work, the shakeout tends to get a little bigger. As of now on the first day we don't take that call. So for now we wait for the markets to react, and globally nothing has happened today. So it's not just say a move which has happened globally. If you look at US markets, the mid cap and the small caps have been underperforming for the last few years. So out here we've had a lot of outperformance. So my view is 6 to 8% from top would be normal.
Okay, so that's the take coming in. 6 to 8% from the top would be normal. But for now, what's holding up in the market continues to be Varun Beverages. It's high by 8%. Oil India was also one of the high flyers. Yes, it's off the highest point, but Nonetheless, that antique note talking about 50% growth in the gas business, 20-30% growth in the oil business for the next 3 years definitely had the street excited. There are a couple of those jewelry companies which are underway with respect to IPO action. Maybe a rub-off impact is what we are seeing on Kalyan Jewelers as well. And then Vijaya Diagnostics has been doing well for itself. On the flip side, however, names like Indiabulls Housing Finance and Piramal Finance are actually coming under pressure. Piramal Enterprise, I beg your pardon. And that's because of the AIF regulation change. In fact, let me go across to my colleague Gaurav, if we can, to get a sense as to what was the brokerage call on these AIF regulations. We also spoke with the management of IIFL Finance about the same. Let's listen in to the views coming in from brokerages as well as IIFL Finance.
So it seems that RBI is on a front foot to make sure that the credit quality of the banking industry in India remains intact. And there were some concerns running around the possible evergreening transaction involving alternate investment funds, funds which are being used by banking and NBFCs to clean their loan book, specifically in terms of the NPA ratios. And to address this concern, now RBI has banned banks and NBFCs in investing in the alternate investment funds. They have also asked these institutes to liquidate all the investments within the next 30 days. And if they are unable to do so, they will have to book 100% of these investments as a provision on their book. Now, how is it going to impact the banking and NBFCs? We have IIFL talking about this, and IIFL believes that this is going to have some kind of negative impact in terms of the NPAs in the coming quarters. We may see some kind of stress loading up in the NPA cycle. We may also see that there will be reduction in the pool of investable assets for the alternate investment funds. Going ahead, they believe that Edelweiss, Piramal Enterprises and Indiabulls are some companies which has higher investments in the alternate investment firms which could get impacted. We also have Jefferies talking about this, and they also believe that Piramal Enterprises and IIFL are some firms in the NBFC's pool which has a high amount of AUM diverted towards such kind of investments. Now they believe that in case IIFL or Piramal is unable to liquidate these positions within the next 30 days, it will impact around 8% of their net worth for IIFL and around 10% of the net worth for Piramal Enterprises. All in all, it seems that Piramal Enterprises has already reacted negatively on this news, and it will be really interesting to see how other NBFCs as well react on this kind of news going ahead.
Principally, it's a good move. So RBI wants to make sure that people are not at the guard of hiding their NPAs, doing some actions which may not be very healthy for both the balance sheet and for the market, and might disguise people. So that way, I think it's a very positive, pragmatic move. And everybody will become more disciplined around making sure that they are keeping their assets in good check and not using these avenues to just camouflage things on the book. So if any of your debtors who are under stress, and if you're moving into an AIF, either now you would need to offload them within 30 days, liquidate it entirely, or you make 100% provision. And the mandate is that those debtors who were in your book in the previous 12 months before you move into an AIF structure. So that's something which is not a very healthy practice, and that should now go away and make sure that people are more governed in their practices and making it more transparent when they are reporting such numbers.
Suraj.
Back with closing trades right here in 80 now. Still struggling actually. So not just we've given up that 21,300 mark, we're swiftly getting close to even breaching 21,200. The pressure points, the Adani names, they're at the bottom of the pack today. Adani Enterprises, Adani Ports. Coal India is down 3.5%. You've got Tata Steel, which is down about 3%. Tata Motors, which is down 2.6%. M&M down 2.5%. You've got an SBI, Eicher Motors, Hindalco, Bajaj Finance, Bharti, Nestle, Maruti. And of course, you know, amongst the big boys, it's L&T, Reliance, ICICI Bank. They're also ordering heavy on the index as we speak right now. But Sunil is back with us. Sunil, apologies for that, audio issues. But yeah, you were making the point as to what explains the weakness in the market.
Yeah, so let me start off again.
Yes.
So basically what I've been saying is that, if you notice that FIIs had sold in the month of September, October on the fear of a rising oil price, right? So soon as the oil prices calmed down, these FIIs made a return back because their call on India being negative due to oil rising they covered it. And the money from November was slight small, but December we've seen 50,000 crores of inflows. Second was that the fresh money coming in is because there's political certainty around the election, and hence policy continuity is expected. At the same time, funds which had taken a call a year ago, let's say 6 months ago on India, if you recollect, from April, May, June, we got 100,000 crores into the market. Then June, July, August, we got another 50,000 crores. So these hedge funds, right, typically book profits at the calendar year end. And last year, you saw between 15 to 30 December, there was about 3,000 odd crores of outflows from FIIs because there was no massive buying in coming in. So this time what's happened is that as the pace of that profit booking goes up and the inflows which have already come in, most of this has come in the 15 days, now the outflows are exceeding the inflows. So when they sell, they are selling the large cap, right? Now the outlook for the Indian market for the next 6 months from FI is positive because the same people will come back in January. But what happens is that when domestic fund managers look at this selling happening, they are then going and buying those because those same large caps are available cheaper, but they have to liquidate something in order to buy. So flexi cap fund, a multi-cap fund, a large and mid-cap fund, in those categories, they are selling off the small and mid-cap. And that's why if you see in this rally, in this selling off, right, though the FIs are selling, it's the impact is felt on the high risk, slightly smaller cap and mid-cap and the smaller cap segment of the market because that reallocation is happening. But that's why I said in January, I expect this to come back because the rate cut scenario and the oil scenario are very positive for equities. And if you saw yesterday, S&P had the single largest flow into it. So there is also some reallocation probably happening into the US market because in the US market, things are looking very, very bright. There's a strong buy call on US market given by various brokers there. So a little bit of combination of these factors. But that being said, India remains the preferred emerging market for the destination for FIIs, and I expect the flows over the next 6 months to continue. So this anytime they're selling, domestics are going to buy. Because good quality large caps, if there is a correction, they will buy. But that comes necessarily at the cost of the smaller cap end of the segment, because there, as you know, the liquidity and the free float are very less. So this is a normal phenomenon. I would expect that till December 31st, some profit booking will continue, and there would be a little bit of volatility and nervousness, highest at the small end of the market, highest in the cyclicals and those kind of things. That apart, there's also I think a news from Accenture yesterday, which didn't give a good guidance on the IT side, which then immediately people are reading into whether Indian IT package also. So the little bit of maybe nervousness around that guidance that Accenture gave in the US markets is also having a spillover effect. But these are all very short-term, temporary. I would say in the run-up to the elections, I would expect markets to cover these losses, and reach new lifetime highs. Small period of consolidation may be there.
Sure. So expecting that there is a bit of a top that we've made for ourselves this year, and there might be a bit of profit booking towards the end of the year. But should we use these opportunities, Sunil, to re-churn the portfolio? For instance, if there's a dip in consumption names or real estate basket, which was supposed to be in a long-term uptrend, should this be the opportunity to make those portfolio bets?
That's an excellent thing that you said. So if you notice, the correction that's happening is happening across infra, cyclicals and everything. But in infra, as we are aware, private sector corporate capex hasn't yet taken off. So a lot of the money that went into infra, anticipating an early capex cycle revival on the private sector, that's not yet happened. Because private consumption capacity utilization is stuck at 75% levels. So to some extent, consumption is a very good pick. So any correction that happens in consumption, because in the run-up to the elections, liquidity is going to be flowed into the market from the political parties. So I see bottom-end consumption, bottom of the pyramid consumption rising, and hence consumption numbers from the festival season are also going to look good when the January elections, the result season starts. And I expect the consensus estimates to get upgraded for the consumption pack. So what you said in terms of real estate is also part of the consumer discretionary pack. Auto is a part of the consumer discretionary pack, and consumer durables. So I would say anywhere you see a correction in any of these three, right? I think it's a very good time to buy. I wouldn't yet jump into buying infra, even if there is a stronger correction there. I'd like to see the consumption go up, capacity utilization go up, and then I would try to re-enter the infra space because, right, the price has got a little bit ahead of the earnings expectations at this point in time. So consumer discretionary is a very good place to buy on dips today.
if you were to just recap how 2023 has panned out, FIIs in total year to date have seen outflows of 18,000 crore rupees. It's been a completely all through and through DII supported market. When FIIs do make a comeback, which is what you're betting on in the next year, new year that is, what are they going to chase? What sectors and stocks?
So two things here. So first, when you said FIS have been net sellers, there have been two particular periods when they've been net sellers, right? There's Jan, Feb, March when they sold 26,000 crores, and then September and October they sold another 35,000 crores. So this 60,000 crore in that pocket, rest of the time they've been buying. So the outflow was in the beginning of the year was due to the Hindenburg report and its impact, and then the Silicon Valley Bank and the UBS crisis that led to some outflow, and the second part was due to rising oil. But otherwise, the longer term flow into the Indian market has been consistently coming. So when the FIs come back into India, see, they are coming from a super safe market like the US to a emerging country risk oriented market. They will always tend to buy the safety aspects of some market. That's number one. Number two, if you see the composition of FI flows, passive flows are dominating. So passive flows tend to buy the index. So then you break down our large cap index, you're seeing 35% in the BFSI space. So naturally, that's where I expect the biggest quantum of allocation to happen. So banking and financial services is going to be a big buy, right? The second, I would say FMCG consumption, right? Because the consumer goods, which is the FMCG pack, is largely in the large cap space, right? The discretionary is in the mid and small cap. So I would expect FIs to come in and buy. So that will be my second pick from where FIs will put in money. IT, until a couple of days ago, would have been on the top of the pack because they understand. But this, like I said, the guidance from Accenture, need to wait and see whether there's going to be an impact. And the IT outlook is not great on a slowing US economy, then maybe they will not jump back into it, and maybe it will take a little more consolidation in IT space to happen. Pharma is a defensive bet, so I would get reasonable allocations into the pharma space from FIIs. So I think these will be my top bets on where I think the FI money is going to come in when from January onwards, I see a strong inflow into our economy, into our markets.
That optimistic note, we let you go, Sunil. Thanks so much for making time and speaking with us. So January onwards would be the return of the FII flows, and that's something to watch out for. But we're also watching out for what's happening in the Parliament, because it seems like that the telecom bill is likely to be passed soon. Let's go across to my colleague Sumita to get the latest on this story. Hi, Sumita.
A watershed moment for the telecom sector. Well, that's the word coming in from industry players on the recently introduced Telecom Bill 2023. Union IT and Telecom Minister Ashwini Vaishnav will be moving the bill today in Lok Sabha for discussion. Operators Association of India has hailed the bill progressive, one that focuses on the security of networks and is user-friendly. Airtel CEO and MD Gopal Vittal calls the bill, says that the bill will accelerate the rollout of telecom infrastructure in the country. Remember, India's rollout of 5G has been called as the fastest in the world. Vodafone CEO Akshay Mundra in a statement says that the bill carries benefits of digital connectivity for all, besides appreciating the punitive provisions mentioned in the bill. Mehta as well says that the bill signals their support to continue to invest in digital economy. In fact, Indian Space Association representing Satcom brand says that the move will be a game changer for startup enterprises, one that will lead to democratization of spectrum. So the bill has comprehensive provisions for punitive measures for spam calls. It simplifies and streamlines licensing. Spectrum rules have been made tech agnostic, and it's ensured that spectrum is available to all. But one provision which has gained some criticism from opposition leaders is around the administrative allocation of spectrum, which the bill claims is applicable only in a few select cases. The satellite industry, for instance, but industry experts say that this is pretty much in line with international standards. So policy think tank The Quantum Hub says, and I quote, it says administrative allocation can prevent spectrum hoarding by dominant players and reduce access costs for startups. In fact, the IAMIA as well says that, of course, companies, this should be maintained to allow innovation and further deepen the penetration of internet in India, and also to strengthen startups. So while the bill is up for discussion today, but it surely sets the stage. This particular clause sets the stage for global players to enter and expand connectivity.
Okay, Samita, we'll leave it at that. In fact, Soni, good to have you on the show. We'll let you go as well on that note. We'll take a very quick break. When we come back, track the last lap of trading this afternoon.
Welcome back. Well, the market is looking okay. We are witnessing a further fall actually in the market. We are below the mark of 21,200 thereabouts as well now. So overall the weakness continues for the index 21,166, and that's one of the sharpest falls that we have seen in the last couple of months. At the index level, it's Adani Ports which is down 5%, Adani Enterprises down about 5%, and then UPL, Tata Steel are some of the other names. Bank index is not too far behind as well, almost 700 point slide coming in there. PNB, Bandhan Bank, IDFC First Bank, these are your top losers there. The next 50 actually has lost over 1400 points, so very sharp cuts across the board with bigger cuts coming in from the broader market arena. But we also have Shivangi Sarda as well as Dipan Mehta joining us on the show. Dipan, let me first take it across to you. What should one do in this kind of fall? Should they just build onto their portfolios and allocate more money? Is it time to book some of the profits off, or do nothing, just sit on the sidelines?
Good afternoon and thank you for having me on your show. I've generally been a bit negative on the market, and we have been advising investors to trim their positions. And even in this correction, my advice would be to just lighten up your portfolio, get out of trading positions or leverage positions. And if there are weaker stocks in your portfolio, which are valid beyond their underlying fundamentals, then those certainly you should try and lighten up the positions over there. Whether this actually is a deeper correction, that only in next few trading sessions will we'll able to evaluate that. But at this point of time, I would say it's better to be cautious and not buy into these declines.
Okay, quite interesting. Dipan, also, one is wondering whether to first profit take from mid and small caps, because that's where the chunk of the money has been made, because large caps, relatively still have some pockets of underperformance.
That's right, I think, and actually you're going to enter into a phase where portfolios will start to underperform the Nifty and the Sensex. Till now, it was small mid-cap stocks and individual client portfolios which were giving steady returns much higher than the benchmarks. But that trend will reverse. And if you have to be in equities, and you don't want to really time the market, but want to keep your allocation intact, then I would shift a larger and larger portion into the top 4 or 5 market cap companies in the Sensex and Nifty. And now with the way US markets have done, and with Accenture's results, it's very clear that you could expect good tidings from the software industry 2-3 quarters down the line. So that's a whole new avenue, whole new sector with very large cap companies which open up for investing. So I think if you just buy the benchmark Nifty, Sensex, ETFs, I think those will outperform the broader markets.
Okay, point taken. Shivangi Sarda also with us on the show. Shivangi, what's your view at the index? What will be that support level now to watch out for the index?
Good afternoon. Thank you for having me. So we've seen that after the rally of the last 8 to 9 weeks, the index is taking a bit of a pause over here. It's just a healthy correction over here that we've seen. Now, 21,000 would be a crucial level to watch out for as support. Now, looking at the broader structure, the trend remains intact. So one could actually look for buying opportunity. But then again, for a perspective, some selling can be seen. And 21,000 would be a level to watch out for. Now, the recent high, which is 21,500, would act as a crucial resistance level over here. So these are the levels to watch out for the index. Now, talking about the Bank Nifty, we've seen that this index has, faced, comparatively, it's been in a more range-bound manner as compared to Nifty. And over here, one should look out for 47,250 levels as a crucial make or break zones. For an upside hurdle near about 48,000 zones.
Right. Naresh, the selling hasn't abated much. Within large caps, what's looking like the weakest link to you?
So I would say the weakest link is across the board. We are seeing banks which have continued to correct because they've moved up. So we are not seeing any major weak links. Everything which moved up the most has taken the major correction. So if you look at FMCG, which has not moved up, we've not seen much of a correction. If you look at another sector which has not done well, say big time pharma, that has not corrected as much today. So the case is we are seeing a shakeout, and in this case we go back and retest the last gaps which were at 21,000, 21,200. So we've come into that band wherein you want to buy. So at current levels it becomes a buy wherein you keep a 150, 200 pointer stop loss and expect a slow and steady up move back towards 21,600 if the trade plays out. And this has been the way one could have traded all the way from 19,000, 19,500, wherein you bought every dip, kept a stop loss, and you never got stopped out. So right now at 21,150, 200, that's a similar case wherein you have a 150, 200 pointer stop loss. And upside, we could again go back to 21,600 levels.
Okay, point taken. But for now, it's just a very sharp fall. That's why we are talking about it time and again, though all our technical experts are saying that it's a healthy consolidation given those series of gap ups that we had seen. So 21,100 has been held for now. Let's see where we move here on. Only 4 index stocks are actually in the green. HDFC Bank is holding one end of the market for you. You also have ONGC and then the FMCG names, as we pointed out. The defensives are coming to bat for the bulls. So Britannia and Tata Consumers, these are the names which are still sitting with a gain of around 1%. It's Reliance, which is down 1.5%, L&T, Infosys, as well as SBI. These are some of the names which are actually in the red. But Dipan, if we have to talk about valuation comfort, now apart from IT, even IT for that instance is not providing a whole deal of valuation comfort because they're still trading higher than the 5-year averages. Do you only see value on the table for, let's say, select financials and PSU banking names, or is there any other pocket as well where valuations still provide a decent risk reward?
I think it's not so much the valuations which bothering me as much as the technicals of the market and the kind of exuberance and overheating which we are seeing in many counters. And today's correction, and if the market corrects by another 4%, will not really correct the valuations. I mean, valuations are way beyond. They were stocks are more expensive than when Nifty was at 20,000 or thereabout. So it's not some of the valuations, but the structure and the present setup of the market which can take it lower. It's not that the fundamentals have changed, to assign a lower P multiple. It's not that growth rates or corporate profits have been impacted. It's just sentimental, and partly it's a natural correction which is also underway. So tactically, you need to lighten up on your trading positions, investment positions. And there's nothing major that one should do, like sell off the whole portfolio completely or start shorting the market. Just small incremental adjustments in the portfolio to navigate these kind of minor turbulence trading days.
Okay, 21,200 as well, getting breached now, 21,069. Naresh, we don't seem to be stemming the fall at all. We're already staring at a 300-point fall. Where does the next support come in, both for the Nifty as well as the Nifty Bank?
So if you look at Nifty, we made a big gap up move around 21,074. And if we go towards Bank Nifty, a similar gap up comes closer to 47,300, 200 levels. So we are testing those gaps, which was the recent one where we started this momentum from. So actually at this point of time, one needs to go contra and build some position and add more on a 100-pointer further dip on the Nifty. Similarly, 47,300, 47,000 should hold for the Bank Nifty, and we could make a bounce back from those levels.
Okay, point taken. In fact, in the meantime, there was some sage advice that we got from Kenneth Andrade as well. He did talk about the over-exuberance in the market just a couple of hours ago with us. And he said it's time to become a bit more cautious and take a relook at your portfolio, consolidate and only double down on the names that you're willing to ride through even in a downturn. So that's the kind of conviction he was asking for. Listen to what more he had to tell us. Okay, we'll try and get that bite ready, but he was quite positive on pharma as one space. Chemicals as well was one of the baskets that he think was quite positive. Metals hasn't done quite well for them so far, but he's still quite bullish on the prospects of some of the names because the corporate deleveraging is something which is actually panned out for the metal sector quite strongly, and they hope that will play out in terms of the operating leverage very soon. So that's one pocket that they like, but overall getting a bit more over exuberant in the market. And of course, he said that the over exuberance can live for longer, but be okay to leave that 10-20% for somebody else and you get out at the right time. Listen into that recommendation.
There's obviously a significant valuation gap that exists between some of the small mid markets and the large companies. So it's quite a no-brainer as to where you should be at this point in time, right? And that's how you need to necessarily allocate. Also, if you're doing a fresh allocation, 2024 valuation advantages are with the big caps, but it's not to say that the big caps are significantly cheap. The market as a whole has traded up and it's hitting all-time highs. And you need to be cautious across the entire. Some of the pharma names, some of the chemical names, We find a company in logistics or two doing reasonably well. We find some of the discretionary spend names. They're not very cheap in terms of valuations, but I think on every corrective they make that they become very interesting to keep adding value, adding your position to. And of course, the our favorite has been, for some time has been commodities, so it hasn't done too well. I think both in terms of where the balance sheet construct of these companies are, they are paying back debt quite rapidly. Their cash flows are close to their all-time high, and their expansions are all hitting meaningful size in 2024 into 2027.
Right. Dipan, what are the indicators that are telling you that there is exuberance, if at all, in the market right now?
Now look at the oversubscriptions which are coming in the IPO market, the primary markets. And we've had a continuous rally for last so many weeks. Markets have moved up and they always move up the way they have. At the same time, trading volumes also have moved up significantly. We are seeing a lot of block deals. That means long-term investors are selling their positions. Promoter selling also has come through. So these are indications that there is some over-exuberance. Markets may have stretched themselves a bit ahead. So it's nothing which is, like a bubble territory. Let me be very clear. It's just that in a bull market, there will be phases where you feel that maybe it's slightly overvalued or overheated. And at such stages, which I think were last 2-3 trading sessions, you just kind of become cautious. Don't put fresh money to use. Don't increase your trading positions. Wherever you feel stocks are performing or have jumped up without any underlying improvement in the fundamentals, you exit those positions. And the entire strategy you do should not impact more than 10-15% of your portfolio. A little bit of cash is always helpful because of corrections you can buy. And fresh cash flows, whatever you get, fresh investable surpluses, just hold on to them, put them in income funds. And these are just, sort of simple, commonsensical strategies that investors can apply. And they'll see a big difference in the returns over a longer period of time.
Taking a little bit of common sense is what you need sometimes, but time now to actually also, go across to Somit, because the point that you were making on the kind of IPO subscription figures that we have seen is quite interesting. But the other interesting bit is, while the number of IPOs have been the highest this year, the quantum hasn't been as large, because of course a couple of years ago we did see LIC and those slew of IPOs in the sense of Zomato, etc. come by. Though as far as QIP is concerned, it's trending like a year which is going to see the highest amount of QIPs happening. Let's go across to Somit to get that detail as well.
Well, a lot of QIPs, IPOs and block deals have been happening in the market, but do remember that the funds raised so far from all these three transactions is still not the highest ever. When it comes to IPO, around 11 companies have either announced or will be or have already raised funds via IPOs, and the total amount raised is close to 8,300 crore rupees. And when it comes to the calendar year 2023, nearly 57 companies have raised money via IPO of close to around 49,400 crore rupees. Of this 49,400, nearly 42% was fresh issue and 58% was an OFS, where existing promoters or investors have sold their stake. Now, this amount raised is still not the highest ever, because in 2021 we had seen IPOs worth around 1.19 lakh crore rupees. Now, when it comes to QIP, around 9 QIPs so far in December 2023 have happened, and the fundraise is close to around 13,900 crore rupees. And the amount of fundraise via QIP is not the highest. In fact, it is highest only since 2020, because in 2020 the amount raised via QIP stood at close to 80,800 crore rupees. However, the number of QIP issues that have happened so far in 2023 is close to 44, which is the highest that we have seen since 2018. Now, when it comes to the block deal data, so far in 2023, close to 13,250 block deals have happened, which is still again not the highest. The highest was seen back in 2010, around 16,582 crore rupees, and the funds that the sellers have raised so far in block deals is close to 3.7 lakh crore rupees. Again, this is not the highest amount that we have seen. The highest amount was back in 2017, where close to 3.83 lakh crore rupees was raised via block deal. But most likely in 2023 will cross this amount, given the fact that a close to 3.71 lakh crore has been already raised by sellers. There are block deals worth around 8,700 crore rupees, that is today on December 20th, and given the fact that there is still a week to go by, this amount of 3.83 lakh crore that we had seen, which was the highest ever back in 2017, can be easily crossed via block deals. So keep an eye out for all the actions that we are seeing both in primary and the secondary market.
Thanks, Amit, for that. But the market fall is not getting arrested at all. 21,130 thereabouts. And look at the sharp slide on the Sensex. Almost 1,400 points shaved off that index. The Bank Nifty is down 500 points. But of course, from the highest point of the trading session, it's off by almost 800 points. So that's a massive dip that we have seen from the highs of the trading session. Though as a percentage, you can say that Nifty Bank is less than 1% down. But it's just from the high of the day that we are seeing sharper cuts come by. In fact, only two names are in the green from the banking index now. AU Small Finance Bank and HDFC Bank are the two names, and the Nifty is sitting with a cut of around 300 points, with UPL, Tata Steel, NTPC being some of the other big laggards. But let me do one thing. Let me take it across to Sharad to get a sense as to how dealing room is actually dealing with all of this and what's been the latest chatter. Sharad, take it away.
In focus are the paper companies, especially West Coast Paper, JK Paper and even TNPL. As what we are hearing from the dealers is HNI buying has been seen and volumes have also been strong, especially in the earlier part of the day. Now our channel checks suggest that the corrugated paper segment has actually undertaken price hikes across various categories, and this is coming up to between 3 to 6% on a month-on-month basis. Now importantly, these price hikes have been undertaken for the month of January itself. And if you look at it, the corrugated demand for the paper has been rising because of the packaging segment. Now, of course, this would be very high, especially when you talk about the third quarter as well as the fourth quarter of this current financial year. Overall, if you look at the pulp prices also, they have also rebounded and they are also on an uptrend on a global basis as well. Apart from this, the demand for the specialty, corrugated and the packaging still remains strong. And importantly, if you look at the second half of any financial year is very crucial, especially because of the deals happening in the paper industries for office as well as school. So overall, what we are hearing from the dealers is that the corrugated prices has increased on a month-on-month basis.
Right. Okay, that's all the buzz coming in on why the paper stocks are seeing some fund flows coming in, and that's the dealing room chatter. Before we start winding up for the day, let me get in some BTST trades as well. Pranesh, anything that you may have?
So I'll take a contra buy on two names again from the PSU basket. First is a buy on ONGC, which saw a massive breakout today, corrected with the markets. Now looks interesting around those 203 levels. 205.6 was the previous high. So stop loss at 200, target price of 215. Second is a buy on State Bank of India, which has come back to retest the previous breakout points of 630.35 levels. Stop loss at 634, target price of 650.
Right. Dipan, just wanted to get your thoughts in, because the assumption is that 2024, and that will be the return of the FIIs, right? They will come in, buy in large caps, and that's why also you need to have a tilt towards large caps, because obviously that kind of huge money is going to find its way into larger market cap stocks as well. Going by that prognosis, do you not think that right now in this current dip, one should be increasing our allocation to large cap stocks?
Yeah, absolutely. I think there is safety in large cap stocks. They have underperformed the mid cap, small cap universe, and there is some semblance of valuation sanity over there. Prospects for some of the large industries which are very high, large cap companies like software and pharma have improved the last few quarters, last few weeks or months, as one would say. So those opportunities also start to open up. And even the performing companies, be it the auto shares or even the capital goods manufacturing companies in Sensex and Nifty, they continue to do well. So from that point of view, I think there is more safety in the large cap stocks. And if you want to have a favorable tilt towards large cap, then it's still not too late. You could still do that shift away from mid cap to large cap.
Sure. Okay, let's see what actually is, the closing picture like. While ONGC, of course, has been a winner today all through, held out by 2.5%. Can't say the rest, that for the rest of the pack. Adani Ports is closing in with a 6% cut. Adani Enterprises down 6%. Coal India has lost 5%. Tata Steel has been a rank underperformer today. Eicher Motors, Tata Motors, Divi's, the entire technology basket. SBI has fallen about 3% today, L&T down 2.5%, Bajaj Finance down 2.25%, and then of course the likes of Reliance, ICICI Bank, Axis, ITC, they have all been ranked underperformers as well in trade. Just looking at a handful of gainers there. So HDFC Bank absolutely flat there. Unilever, relative outperformer, fell a lot less than the others. And Britannia and Tata Consumer are the ones which did manage to hold on to their gains. Dipan, the other story which has really played out well all through this year has been the PSU pack. Do you think at large, PSUs and ex-banks is what I'm talking about, so keep the PSBs aside, but do you think there too one needs to really consider taking some profits off the table?
Profits off on companies where price to earnings multiples are, beyond 50, 60 times trading 12 months. Could be private sector defense contractors. It could be, some of the newly listed stocks as well, which are engaged in different businesses, which are trading at very rich multiples. You could consider even specialty chemicals to that list where trading multiples are quite rich. So has to go industry by industry, spot the companies where price to earnings multiples are 60, 70, 80 times. They're building material companies also. We could look at those companies to lighten up rather than stocks which are still trading at reasonable price to earnings multiples.
Dipan, we'll let you go on that note. Naresh, before we start winding up, given that we've just about defended that 21,200 print on the futures and given that off on the spot Nifty, what's the strategy next?
So the strategy is to go long here and keep a stop loss below 21,000. So at current levels, the risk reward is good. Expect a bounce back, maybe a gap down tomorrow and then a bounce back from those levels.
Shivani, any stock-specific trades that you're quite convinced of, given how we are closing up?
So as for stock-specific is concerned, one stock is Tata Consumer, which is on my radar. This stock has been, continuously adding volumes in the last 1 week. And we've seen a long consolidation breakout. So this makes room for a good upside over here. So this is one stock which is looking quite good for 1020 levels with a stop near 965. Second pick on my radar would be ONGC. We've seen that this stock has also respected its 50 exponential moving average on the daily frame. And, month-on-month basis, we've seen that the stock has continuously been traveling on the upside trajectory and supports are gradually shifting higher. So this is one stock which is looking quite resilient despite the market fall. So recommending a buy here with a target of 212 with a stop near 198.
Okay. Naresh, is the Nifty bank strategy also going to be similar to the Nifty by the day?
Yeah, so on Bank Nifty, pretty similar, 47,000, 47,300 is the support band. So you want to buy here, keep a stop loss below 46,900 and expect some bit of a gap down tomorrow, which you want to add more if it comes or see a recovery from. So overall, we are retesting the support levels, the big gap ups which happened in the few days back, and expect a slow and steady bounce back, not expecting a quick bounce back, but risk reward is good here.
Also, Naresh, wanted to identify some of the contra bets in the market and, just taking a leaf from what Shivani was just mentioning, her call on ONGC, some of the FMCG names like Tata Consumer, Britannia, which have held out. Do you think these kind of contra trades are better off within the large caps for the next few days? I don't know where the selling is going to stall.
So structurally, ONGC looks pretty promising. It is very similar to what NTPC was, which was my top bet last year. The stock has done nothing for the last 10 years, the last 16, 18 years. The stock used to be 190, 200 back in 2006. And it used to be 190 on the day of Russia-Ukraine crisis also. So out here at 200, 205 levels, this is a multi-year breakout. So you want to accumulate a stock and then expect good returns over the next 6 months or over the next 1 year also. So ONGC now becomes the top bet in the PSU basket.
Okay, ONGC, the top bet within the PSU pack. Let's begin winding up for the day. And it's been quite a steep correction, actually. We're going home with a 300-point cut. And to think of it, we started off with that 21,500 plus mark. So from the high to the low of the day, it's been quite a fall that the Nifty alone has had.